Inflation is striking everywhere across the globe, but not here in America. Ours continues to rise. Guys, when can I expect to hand over my truck of singles for a roll of toilet paper? Welcome to the Between the Lines podcast, your weekly lesson on how to approach an uncertain world with positivity and balance. I'm Nikki P, here with my good friends and money brains, Luke Tatum, Rob Brayton, and Corey Sins from Perfect Spiral Capital. Gentlemen, how scared do they have you?
I'm not afraid at all. To be fair, Rob, I mean, I feel like you have something you want to jump in here with right off the bat, but I'm fine. How are you feeling?
I mean, I feel pretty good, right? I think that's the advantage of a lot of what we do. Again, there's a lot of fear out there for sure, but we definitely have set ourselves up to be in a position where it's surprisingly not something you have to worry as much about. Do you still see the impact? Sure. I mean, prices are up. I think everybody feels that and we see it. But yeah, I really think it's not something I have to be extremely worried about just because of the way that we've structured things, and just as a lot of you guys have too. But something that should still want to pay attention to because it does impact everybody, and we have to meet people where they're at.
So, not to put you too much on the spot there, Rob, but you just gave me like a very, very pointed, very vague answer. What does the way we're set up actually mean?
Well, it's all about how you control the flow of money in your life, right? So when you can give each dollar that comes into your system multiple jobs to do, that perpetuates and allows us to have uninterrupted compounding in our systems with the way that we structure things at Perfect Spiral Capital with our clients. So that gives us our dollars. It allows us for those dollars to continually leverage and increase in value over the time frame that we have them in the policies and things that are structured. So each dollar is gaining contractually guaranteed, uh, really in perpetuity until the insured person were to pass away. So it's a great place to store money, but at the same time, it gives us opportunities to put that money to even further use and leverage it even further if we wanted to.
That's the same thing with my family. We're just like Rob said, we're experiencing, at least since 2020, I've been very cognizant about what things are costing in terms of our budget. Our budget has to kind of increase to accommodate that. However, we do have that firm foundation, that store of wealth that is always maintaining and increasing. You just look at it in real time, really, and so that keeps me and my wife confident.
To the actual headlines, what we're talking about today, it's about global inflation. So, the big thing that seems going is all of these third world countries around the world, their inflation's all going down, whatever that means. And America's is on the rise, whatever that means. And obviously, the first thing, when I'm looking at the IMF's website when they're talking about inflation, I see that big old CPI, knowing full well that CPI has a whole bunch of stuff in it that is neither consumer products or so. What is actually going on? What's the picture look like?
Yeah, I'll jump in on this for just a little bit. I want to hear what Corey and Rob, you guys have to say too, of course. But I feel like a broken record because I always bring this up, and I mean, at least once a week in a conversation. But like, what is inflation versus what are we being told inflation is? Like, we don't even have a consistent definition that we're using here. So when the IMF says inflation is up or inflation is down or inflation is decreasing or whatever, what they're talking about is consumer prices. Their CPI is one of those indices that they use, the consumer price index. But they're talking about consumer prices. How much are you paying for the same thing at the store compared to prior to now? But when we're talking about inflation, when you understand a little bit, even a teeny tiny amount of economics, what you're talking about is how many total dollars or total yen or whatever currency, total buying units there are in the economy to buy those things. And so our governments, through monetary policy, central banking, all those things, are decreasing the buying power of your currency every day by generating more and more and more units to buy those things. The classic libertarian joke example is slicing a pizza into more pieces and pretending like it's more pizza, right? It's the same thing. It's the same amount of stuff. The amount of wealth in the economy is the same. You're just making more and more and more dollars in the US to buy the same amount of stuff. So what does that do? It raises prices. And so are we talking about that here? Are we talking about, consumer prices? Like the effect of monetary inflation, the effect of making more dollars is that prices go up. But they're not the same thing. We're having kind of two different conversations. Everybody loves to have a conversation about prices going up because then they have a different solution. They don't want to talk about stopping the money printer, right? They want to talk about something else.
Well, because it depends what you're talking about. I mean, look at, like, say, the boomers and Generation X, man, they love that number go up when they're talking about the inflation on their home prices. But, as me, as a consumer, as a millennial, thinking, wow, I don't know if I'm ever going to have $1 million set aside to buy a modest house. That number looks more like inflation to me than like something that I want happening. It's not the prices going up because prices are supposed to go up. It's price going up because they've diluted our money supply.
Yeah, absolutely. I think a great way to highlight this, and it's one I've used before, is you go back to pre-Fed economy, right? So prior to 1913, 110 ounces of gold bought a three-bedroom, two-bath house virtually anywhere. Nice place, right? You can still buy that today with 110 ounces of gold in most markets. Not all, but most. And that doesn't mean that gold's more valuable. It simply means that the value of the money itself is eroded at such a level of what it is, what it was then. So nothing's really changed in terms of hard asset values. It's that our money is just worth that much less because of what Luke was just talking about, the dilution of the money supply.
Well, and one thing to focus on, like, historically, when we look back to the 70s and when we depegged from gold, as you're talking about, why was the reason we depegged from gold? It's because the rest of the world realized that we were doing almost the opposite by handing out dollars and not making sure we had the gold to back them up. So the idea is we forced our money to inflate on purpose, and everyone's like, "Hey, we're not really cool with you doing that, guys. So I want my gold back."
Well, and I think if you look at some of those articles that we were talking about, it's interesting that some of the countries, or at least I know China, for example, they are hoarding gold, and you do see that their reported inflation, whether or not, again, are we talking about exactly the same numbers across all these countries? We don't know, but it's not surprising to me if they are hoarding gold that potentially, because I have heard that they were talking about maybe linking the yuan to gold in some way, shape, or form. There is a reason why they would potentially have less inflation, because if they're cutting back on their money supply, well, we're constantly inflating ours. Well, yeah, it's going to look a little different there.
Let's also bring this discussion, we'll say, into the modern era, because there's, at least in theory, more than one type of non-inflatable asset out there now, with Bitcoin being added to the mix. And a lot of countries, I mean, frankly, the entire system is looking to get in bed with Bitcoin at this point. As not a day goes by, I don't hear about some 401, some state or city's pension program buying Bitcoin. I just heard, oh my goodness, Harvard, as a university, once published an article that Bitcoin is more likely to reach $0 than $100. Just bought it at $118,000 a share. So it's like, um, there's something else obviously entering the market. Do we see that affecting things specifically for us, the U.S.? I know we touched a little bit on this with episode number 1, but How do you guys feel like that fits into this whole inflation thing?
I think that you've got things like precious metals, silver, and then you have the digital ones, and that's kind of what I've seen a lot of Bitcoin being described as is the digital gold. And for better or for worse, whether it's for good or for bad, there are so many different options. But right now, Bitcoin is the option. It's the one with the greatest adoption. And I was kind of thinking about when Rob was kind of talking about China, putting themselves back onto a gold standard, and tying it to Bitcoin. So Bitcoin's biggest um, draw is that it's so secure, that it's a deflationary, it's tied to something. So what would happen if a major world currency decided that they were going to, and I think this would be in a form of market factor, but they would put themselves on gold, and then everybody starts to be attracted to that because it's more sound money than hitting a button, control P and stuff.
You actually got me thinking here, Corey, because the idea of, is this a good thing or a bad thing? I don't want to put like, the libertarian bent that I have on the idea of Bitcoin. To me, the question we really, certainly for our purposes here, should be boiling it down to is the idea that, are you going to be better off with an asset that is naturally deflationary, like Bitcoin, as opposed to something that is naturally going to inflate, like our currency? Like, if we're talking wealth, there's no question that you're better off having your money in Bitcoin than ever being in anything denominated in dollars, because that just continues to fall and fall precipitously. I mean, we take it all the way back to 1913 to now. Like, that curve is parabolic at this point. It's insane. Whereas, you look at that Bitcoin curve, it's parabolic in kind of the exact opposite way.
And that was my point, was that we're in the system that is completely set for debt. When we want to save, invest, and move ourselves forward, and that's we're going against the grain when we're talking about infinite banking or sound money, or sometimes just doing the right thing in the right moment. So there's a lot to that.
Yeah, I mean, the unfortunate reality, Nick, is that we, have like if you're a US citizen watching this podcast, listening to this podcast, you have various things that you're going to have denominated in dollars, period. You don't get to pay taxes in Bitcoin, for example. And so you have expenses that are in dollars. You must be able to convert to dollars. You must be able to spend dollars. My wife and I just this morning at breakfast talking about Bitcoin adoption rate, right? Like the availability to spend cryptocurrency. Like, we live in Arkansas. I am telling you, most of the state of Arkansas did not have electricity until the 70s. Okay. And so we are behind the times out here. There's nowhere. I don't know of one place within hours of driving that I could spend Bitcoin on something, right? So if I want to transact, it's dollars, right? And I do want to transact. So that is, it creates a necessity to hold dollars. And so if you're holding dollars, where do they go? Do you stick them in a savings account earning 0.5%? Do you stick them in a money market account with an online only bank where there is no physical location and they're just going to pull the plug one day and say, oh, sorry, it's a bank holiday? Or do you put your money in a private contract with a 100+ year track record, mutually owned company where you own and you control by contract all the access to the funds? Which is what we do. I mean, that's what we all talk about here at Perfect Spiral Capital, right? We're encouraging people to become their own bankers. You can have some money in a checking account. I'm not going to fault you for it. I have money in the checking account, right? You have to be able to transact. But where do your dollars live outside of that? We all love Bitcoin, right? Okay, Bitcoin has gone up a lot over time, but it's also tanked at many different periods of time. Depending on when you buy, when you need to get out, it's the same problem as a 401k or any other, stock market based investment or anything like that, Oh, well, this is not a good time for me to exit. Well, I need dollars to spend. I got to pay my taxes. I got to do whatever. Okay, do you want to be in that situation all the time? Fine, put all your money in Bitcoin. Do you not want to be in that position all the time? Okay, maybe you should hold some dollars, right? I mean, I feel a little weird having to walk through that, but like, you know what I'm saying? You've got to have access to easily spendable money, and you don't want to have to time the market to do it. And so, where does that belong is the question that we're always answering with clients, right? And I would say that belongs in a properly structured dividend paying whole life contract with a mutually owned company.
Well, and certainly, I can ask lots of questions about, is Bitcoin's volatility already starting to become less of a factor? I mean, when you're dealing with more institutional money as opposed to like individual actors, you're naturally going to get less volatility. And as adoption picks up, eventually is trust, becomes a factor in there. Eventually it's going to overtake, it's going to become the new gold, and it's going to have that track record that gold does. But that's that's the Pollyanna. We're looking at the future. Who knows how long it takes us to get to that point? In the world we're at right now, the only thing that has given you the straight dividends, the history and the track record, the positive history in particular, is the IBC method.
So lots of different things that I could go into there, but I think, what Luke was highlighting on and what you were just kind of talking about too, Nick, is this is like the, dividend paying whole life insurance through a mutual company is real economy. It's 100% reserve system. There is real tangible asset that exists within that product, within those companies. And even in Bitcoin, that does not technically exist. We don't even truly know the real value of Bitcoin because we're using inflated dollars to compare it against. So if we had a real currency, a true stable currency, what would the value be? I don't know. I don't think any of us really know that. So the only true comparison I think you could potentially do there is, how does Bitcoin track against fundamental gold pricing? If both are inflation adjusted, you could begin to get an idea of what it might be worth. So do I agree with deflationary type asset like Bitcoin over an inflated dollar? Absolutely. I think most anybody wants their purchasing power to increase over time. But that is what we can do within the infinite banking system in some respects, and that we can put in dollars today that generate multiples of dollars in the future and do so on an ever compounding basis. So that's where when we talked earlier on in this, in our episode today, that's where the security comes from. These dollars they're growing, and that is real economy, meaning that if the dollar was gone, it would just get revalued in the new reserve currency or whatever it might be, because there's real actual value, real actual economy behind that product. And I think that's the thing that gives me a ton of confidence about this, especially as I think all of our knowledge has expanded within the economic realms. It just changes your whole philosophy and really gives you a lot of security. And that's something that I think a lot of people need in our environment today. They want to feel more secure because it does not feel secure if you look at what's going on.
One thing I wanted to add is that we also aren't excluding anything. We are talking about our firm foundation, our warehouse of wealth, where our wealth resides. It lives there, and then it doesn't sleep there. It shouldn't. It goes out. It can become precious metals. It can become stocks. It can become Bitcoin. It can become your neighbor's house that's looking to sell and you needed money. It can be a lot of different things. So I think sometimes people have these kind of closed mindsets, and it might not click for them because they don't realize that this is just the starting place for launching off.
Right. We're not anti-crypto. I'm not anti-crypto. Like, we're not, I think this has already proved the point, this episode, but like I love precious metals because I can hold them. I have silver in my hand, that kind of stuff. And but I love Bitcoin, other cryptocurrencies, a few of them. All that stuff. All that stuff is valuable, and it's also important to distinguish between saving and investing, right? Because a lot of what people are doing when they look at the rapid price appreciation, or maybe you could say the stability versus the depreciating dollar, when they look at that, when they look at a chart of the Bitcoin price, a lot of people, not everybody, but a lot of people are in that to try to catch that train and ride that train to more money, right? The goal is to make money doing it for a lot of folks. So are you just investing? Are you just investing in Bitcoin? Or like, are we trying to bring about a new libertarian world order where we're all transacting in a non-inflationary currency, right? I mean, which one is it? And if it's I'm just investing, well, cool. Put your money in a properly structured policy, deploy the capital that you accumulate there when the timing is right. Have a lot of powder dry. That's what in the housing market collapse, 2007 and 8, all this stuff. My wife and I were like, we are never going to get caught flat-footed by this ever again. Right? And I didn't know about IBC at that time. But I was putting myself on the path. I was priming my reticular activating system, teaching my brain what to look for to find the method to make sure that we had lots of, dry powder, lots of resources, lots of capital available to deploy the next time all the stocks were on sale, the next time all the real estate was on sale, the next time, when it's an excellent move is when you should make a move. I'm against dollar cost averaging. That's a whole thing. I hate to even open that can of worms, but it's, you don't just take a deduction out of your paycheck. That's not investing. It's looking for good opportunities and taking action on them. And that's what infinite banking allows you to do.
I love what you said about that, Luke, because when you think about true investing is about finding the right opportunities where you control the vast amount of the variables. And dollar cost averaging is not doing that. You don't control most of the time what you're putting into. You don't have any input into whether or not it goes up or down. However, when you are truly finding real opportunities, you tend to have a lot more control on those specific variables that are in there or might be at play. Let's say there was another housing crash. Well, if you know that it's going to come back, well, that's the right time to buy. Well, that's controlling some of those variables. But how do you do that? Well, you have to have capital. And that's what a lot of the infinite banking concept is about, is capital accumulation that you can deploy as necessary in your system.
And what's the alternative, right? And I know we're going to come up on time here, but just to cap off that line of thinking, right? What is the alternative? Well, if I'm putting money in a 401k, for example, every week, every 2 weeks, whatever, for 15, 20, 30 years, you might have a lot of money. It's pre-tax. You got to pay tax to get it out. You got to wait for them to transact, whatever. So if the real estate opportunity of a lifetime is in front of you and you've got more than enough in your 401k to get at it, imagine the pain of trying to make that happen, right? Imagine calling them and telling them to sell out of the market and, oh, well, we've got to mail you this disclosure and you have to review it and you have to have it for at least a few days. I've been on these phone calls with clients, right? And so that opportunity is gone. If you've got an infinite banking policy, you've got a reputable company, you've got the understanding, you've mastered this system at least a little bit, and you accumulate there right opportunities on the table, cool, I can close in 2 weeks. I can close in 1 week, right? No questions asked. You don't have to go check with somebody. The money's going to be there. So which one is better? You tell me. I already know the answer, but you can give me yours.
So once again, the answer is do not be afraid as long as you're doing the right things like you gentlemen tell us to do. So let's close things up for the week. Where can we send folks to there?
Yeah, sure. So, thanks so much for joining us on this week's episode of Between the Lies podcast. If you watch this full episode, then you're clearly interested in the future of money. We've got a free toolkit to help you demystify the future of your money. If you want to get that, head on over to perfectspiralcapital.com/podcast, or just follow the link in the description and get access to that toolkit today. Thanks so much.